Welcome to Limit Up, the weekly capital market podcast. My name is Don Collins. I'm a chartered accountant and business advisor of 30 years and a partner at Findex, a leading financial advisory and accounting services firm based in Australia and New Zealand. I'm here today with Ian Reynolds, trader and investor, former bank foreign exchange market maker, early investor in Bitcoin and tech founder. Welcome again, Ian, to this week's podcast.
Hi, Don. How are you?
Very well. And how's things with yourself?
All good.
Excellent.
Very good.
Making money in stressed capital market situations is tough. A typical investment portfolio will often fail. The world is moving into really challenging times as the US tries to address $39 trillion in debt, contradictory fiscal and monetary policy, internal conflict, and numerous wars. And the rest of the world starts to consider a new global reserve currency, a multipolar world, and aging demographics. So how can we understand what's going on in geopolitics and macroeconomics? Today, Ian is here with his latest press release from Siberia Capital. Ian, to hike or not to hike? And I think you're quoting some historical figureheads as well. Over to you.
Yes, so to hike or not to hike, that is the question, whether 'tis noble in the mind to suffer the slings and arrows of outrageous fortune or take arms against the sea of troubles by opposing, end them. That's what Mr. Walsh will be thinking tomorrow. We won't find out about it till Wednesday, but he goes into the FOMC meeting with lots of difficult decisions. So we have a war with Iran. I don't know, you can toss a coin and get a different outcome every time you do it, right? That it ain't stopping, that's for sure, whatever Trump thinks. That has to be inflationary in the way that the Fed seems to manage it, or the government, should I say, measures it. The bond market is calling out for them to hike. If they hike, then probably 10-year rates will go lower because they're addressing the situation. But if he does hike, then, and rates don't come lower and won't go lower, a lot lower, then the US government debt is going to obviously be more expensive. Currently at $1.25 trillion a year. I can't see him making a decision that will please everybody, if not anybody. So it may well be that they decide not to do anything, but I think the market will be really not impressed with that. They've let him get away with, blustering last week and talking about all these committees and stuff like that. But we need action. We need it now.
So markets pricing rate cuts, or are they pricing in no change or a hike?
Pricing in hikes.
Right. Okay. And are they doing so because inflation is not under control then?
That's right. So we have seen inflation get a lot higher, and okay, that hasn't further accelerated as the war was seemingly over and the price of oil came down. But of course, the price of oil has gone up again. And, what you measure in terms of a basket of things over the last 2 years is largely irrelevant, but it's the expectations of inflation that drive inflation. If the population thinks that things are going to be more expensive tomorrow, they go and buy it today. So, and that's what he was referencing last time, in that the expectations of inflation seem to have gone down a little bit post the war seeming to end, but now they will have increased again. So that's kind of where we are inflation-wise.
And the other things you outline in your release, you talk about tech stocks are falling. Do you want to highlight that or elaborate that on a bit more?
Yeah, so in the last few weeks, we've seen Oracle down 65% from its high, and we'll go through that in the charts. We've seen Google, despite really good results, get absolutely hammered. And we've seen lots of once bubble-like stocks getting hammered. We'll go through those in the charts. What used to be called 3 months ago the safe haven in chip stocks, that's not the case anymore. But the rotation into more stable tech stocks like Apple has been big. So Apple's been doing really well. So there is a rotation, and now there is tech companies out of China that seem to be doing really well and seem to have gained ground on the US version. So that's an ongoing situation. But really, the story is, they're still spending all this money that's keeping the US economy afloat, but is it actually achieving anything? And you just can't keep spending it because there's not that much money left in existence. So it has to come to an end at some stage.
And you mentioned there about equity markets, nearing their highs and allowed to crash. Are they hiding deeper market stress?
Equity markets are looking forward to what is possible in the next 2 to 10 years. So I think there's lots of papering over the cracks with private equity, private credit, uh, commercial real estate markets, like extend and pretend by banks on real estate. That's a continuing and ongoing thing. Sooner or later, it will come home to roost. But currently, markets, I would say 3 weeks ago, markets were bullish, but beginning to become careful. I think markets are neutral, if not bearish now, in that there's so much bad news out there. And so that capital will rotate, and it may rotate out of equities into something else. We'll find out in due course.
Back to the war, you go on to mention about China is now hoovering up gold at record rates and a new monetary system upon us. Do you want to give us more background to that, if it is?
Yeah. So in the last, I don't know, 5 years, let's say since COVID, China's been buying gold like crazy. Over on the 24th, which was Friday, was the date in which all the big Chinese banks told their customers they had to sell their ETFs for physical gold or just sell for cash, obviously. And that's part of China, the People's Bank of China, trying to cut out excessive leverage in the system. But really, they've been importing so much gold that I think they don't want it leaving, and they don't want the citizens necessarily having paper gold. And if you go down a bit in the press release, as Iran has its grip on the petrodollar market, i.e., the Straits of Hormuz and other straits out there control, a significant amount of the oil in the world, and that oil is being sold for yuan mostly at the moment. So it's kind of created a different financial system where you can secure things in gold and park it in gold until you want to buy something with your whatever you want to buy. So it's creating a quasi gold standard without having to have a reserve currency that funds the rest of the world. And you've seen China open vaulting platforms in Hong Kong, other places in China, Middle East. So all of the precious metals are heading east, and they're giving us back US Treasury bonds.
So is that really their defensive reserve strategy, or just a broader challenge to the US dollar system?
Well, I think everyone in that area of the world wants to get out of the risk of being held to ransom by the US dollars via sanctions or having their assets frozen. So predominantly their holdings were in US Treasuries, and they're getting out of it as soon as they can without alarming people. And all the US centric commentators would go, no, of course not. It'll be decades. But the first part of that is securitization by energy, which is what the US did since the petrodollar got invented by Henry Kissinger in 1973, post coming off the gold standard. So effectively, because Saudi Arabia agreed to sell its oil only in US dollars, effectively the US dollar was secured by oil. Now it looks as though the yuan is becoming secured by gold, and petrol is the lubricant in it. The security is gold rather than oil. And so rather than the de-dollarization process, which takes decades happening, this is the first step towards a new monetary order, I would say.
Right. Okay. So if that confidence in the petrodollar weakens, what are the implications for gold, all US Treasuries, etc.?
Well, US Treasuries are, well, there's 40 trillion of them to start with. Currently, the plan is to get stable coins to be secured by US Treasuries. So there's always the buyer of last resort that is not the Fed, which is the stablecoin market. But I've always thought if your stablecoin is secured by something of which there's 40 trillion in the world, the stablecoin issuer will forever be buying, devaluing US Treasuries to keep the peg along. And it comes to a point where it all falls to pieces. But as the US Treasury desperately tries to keep solvent, it'll try anything, obviously, to achieve that. So we're at a point of great sensitivity, I think, in the great game of the monetary order. And this is why, as we've been discussing for the last few weeks, suddenly Walsh, Besant, Trump, they're all aligned. They're all trying to be trustworthy and doing the right thing and being, accountable for their own actions for once. So I'm really sensing that they know how dangerous things are now as well, which is why tomorrow's meeting at the Fed is really important, because although monetary policy itself isn't a great tool because it's a hammer, it's a blunt instrument, if we lose confidence in the central bank of the global reserve, that's a really big thing.
Yeah, absolutely. Anything else out of the press release before we look at the charts?
Not really. I mean, I was just comparing the Iran war to Vietnam, where
Yes.
America assumed they were going to win really easily, but it went on for,
Yes.
how long did it go on for? Was it like 15 years or something?
Vietnam War.
Way longer than you
Yeah,
think.
absolutely.
Because you
Yes.
see all the footage of it in the like 60s, don't you?
Yes, you do.
But really, I think it was the mid 70s where it
Well,
ended.
it went through most of the 60s, absolutely. Yeah, maybe into the early 70s.
Yeah. So these things can hang around, and I suspect that Iran is going to cost them a lot more than Vietnam will
Yep.
because of its geolocation, hold on the
Yes.
oil and stuff.
Yes. And does that make it a more important monetary and geopolitical flashpoint with the control they have?
Absolutely, yeah.
Yep.
And you know what? The US seems to go do what the US does best, which is bomb deserts,
Mm,
which
mm.
is completely and utterly pointless.
Yes.
Except it costs them even more money.
Yes, exactly right. Yeah. Up goes that 39 trillion to 40 trillion.
If it's not there already, yeah.
Exactly right. Okay. Let's probably look at those charts then.
Let's take a look at crypto to start with. And we've had a little bit of positive run. This is Ethereum. Let's take a look at Bitcoin. So we have had a bit of a run, but it's really not very convincing. I don't want to linger on it too much because it's not really doing that much, and at the moment, at least, doesn't matter. Gold has come down from a very big high. It's down 30% now, which is nice if you're a buyer and you haven't spent your money already. Obviously, went into parabolic move, crashed off, be getting rid of all of those get rich quick sters, and is now beginning to form a base around 4,000, as we've discussed in the last few weeks. And you can see that rounded bottom forming, so much more confident now the markets than it was even last week, I would say. Starting to uncorrelate, if that's the right word, from the price of oil and the dollar. Silver showing a little bit of bid as well, but really just not being bearish anymore is a good start. The dollar, which is the wrecking ball, has been higher in the last few days as the war has continued. Really stuck in a range. Can it get through this top? Who knows? But we are at the bottom of a very long secular trend, which goes back 15 years, which shows the dollar going higher. So this is the trend. You can see it's there. And if I try and get there we go. So you can see the dollar has been going up, appreciating, and it's dropped out of the trend and is now kind of working out what it's going to do. But a big move higher to the top would absolutely decimate risk assets. As we discussed the last few weeks, liquidity is low. Rates are restrictive because they should be higher. That's what the market thinks anyway. And you can see all the rate cuts here, which have blended together because I've moved the charts. Those cuts which should effectively have lowered the dollar and rates haven't. So what does that tell you? That tells you that markets don't believe rates should go lower. And we can see that particularly in the 10 years. And we've got the same rate cuts in here as well. So Fed cuts rates 3 times, rates go up. This is inauguration day when Trump got in. So pretty much rates, 10-year rates are now higher than when he came in by a little bit. But if you remember the rhetoric coming in, rates are going lower. We're going to get power to really cut rates. Hasn't happened. Market won't allow it to happen. And the market needs a resolution. We can't have the people in power not understanding how the monetary system works. And thus we need them to hike rates to give the market more confidence, is what the market is telling them. Equity markets, really important at the moment. I don't normally concentrate so much on equity markets, but it's the only thing keeping Trump alive going into the midterms. We must not allow equities to fall because the ownership of equities broadly across America is enormous now. This is SpaceX since it IPO'd, and you can see it's down from 150 to, let's say, 110. So it's lost 15%, even if you bought it at the lowest point, and it's actually halved if you bought it at the high. So there's a lot of capital being burnt there. IBM, who seemed to have pretty good solid results the other day, dropped 25% in one session overnight. Well, look at that gap. It's enormous. That's what your Romanian currency or Greek currency or something does in a crisis. This is not what a bellwether Dow stock should do. Oracle, which is one of the most famous database systems in the world, is down 66% from its high. Its high was September last year. So Oracle has been investing massive amounts in AI and is now cash flow negative. So these are like individual stocks, whereas the NASDAQ can't get any more momentum to the upside and is developing a bit of a trend there downside. I think the best chart is the S&P, which is a mixture of types of stocks. And although you might say you're just drawing lines on here, Ian, which is true, the market is in clear indecision between the wedge here. Broke higher, but didn't convince itself, and now has gone back to indecision again. So stocks are really driving sentiment at the moment. I think I'll leave it there for this week, and we'll have a good look at individual things after the FOMC announcement on Wednesday, where obviously the market will be looking at every word Mr. Walsh says and pulling out their conclusions from it.
Anything else of note coming out this week?
Yeah, so next week, obviously, got the Fed, Bank of England on Thursday as well. And we have Bank of Japan on Friday. So dollar yen up nearly 164. They've been intervening at 160. How far can the market push it? Quite a long way, I think. Just a couple of things. We mentioned China stopping the public buying ETFs, gold ETFs. US Treasury has been supporting its own debt by doing buybacks, trying to stop those rates going higher, which really is digging to me saying that's why we need Mr. Walsh to do it via a vote of confidence rather than having to spend money that it doesn't have, propping up its own debt market.
Well, that was certainly intriguing. Some interesting trends and outcomes there. Well, that's another wrap of this week's Limit Up podcast. This and previous podcasts can be located on the Siberia Capital website, or alternatively, you can subscribe by accessing the link at www.siberia.capital/contact. Thank you, everyone, for listening in, and thanks again, Ian, for this week. Thank you again.
Thanks, Don. Cheers.